Have you often heard that interest rates have a big influence on the stock market? Is that even true? And why are we even talking about interest rates right now if they're at historic lows? Well, I can show you some things that you can follow over a period of time that you probably will find very helpful. Stay tuned. One of the first things we learn about when we're analyzing the stock market is that interest rates are bad. If interest rates are going up, that usually means stocks are going down. Is that really true? Well, I'm going to show you some information to actually go through that scenario right now, or that hypothesis, if you will, and just see if that is in fact true. Also, with Congress passing a lot of stimulus packages, they're putting a lot of money into the U.S. economy. Is that going to have any kind of an impact on things in the future? Well, I'll show you some things that you can look at so you can start to see if that does have an impact and what kind of an impact that might have. There is one thing that we need to be careful of. If you've been investing for very long, and I've been following the market since the early to mid 1990s, and pretty much during that whole time, we have never been in what is called a high interest rate environment. I'm always hearing about it, and people are always saying that within 6 months, interest rates are going to double, and everything's going to go terrible, and inflation is going to be through the roof, and it's going to just spiral out of control. Well, I've never seen that happen in the time that I've been following the markets, and that's well over 25 years. But do you think with all of the stimulus that is being passed and all of the liquidity or extra money that's being sent into the U.S. economy, do you think that that will have an impact at some point? I do. And so there are things that I want to watch just to be ahead of the game to see if inflation and interest rates are going to be a concern in the future. One of the things that I want to address first is, do stock prices go down when interest rates go up? I'm going to switch over to my desktop and you'll be able to see a chart comparing interest rates with the S&P 500. Looking here, you can see that over on the left-hand side, we have a red line. That is the interest rate that is set by the Federal Reserve, called the FOMC, the Federal Open Market Committee. And they get together about every 6 weeks or so, and they talk about the economy. And one of the things that they do is they discuss the idea, should we consider raising interest rates or lowering interest rates or keeping them about the same? And they don't do this directly. They do this by telling the banks, okay, bump up your interest rate a little bit, your overnight lending rate, or push it down a little bit. And they don't actually set it at an amount. They have a target rate that they use, and it's usually a range. Right now, it's between 0 and 0.25%. So as long as we get in between that range, the banks are doing what the Fed has asked them to do. But looking at this chart, you can see this goes all the way back to 1980. You can see at that time we were in a real high inflationary environment. So interest rates really went up too. The idea is when the economy is seeing lots of inflation, they try to raise interest rates to slow things down. The inverse of that is also true. If the economy is going down and people are losing their jobs and it's harder to get loans and things like that, what they might do is lower interest rates. So then banks are more willing to lend to people. It doesn't cost as much money to borrow that money. The idea is that will stimulate the economy. That'll put more money out into the system, and that will help the overall economy. Well, in the 70s, it was just out of control. And then those of you that remember, in 1980, Ronald Reagan was elected to be president. And over a period of a few months, he used this idea of trickle-down economics, or Reaganomics, as they came to be known. And you might also be aware of something called the Laffer curve, where if you cut things more at the high level, that'll filter down into the rest of the economy. Some people really agree with that. Some people think that that's just not good economics at all. But it helped then because over a period of time, and it didn't happen overnight, we saw interest rates start to come down. The stock market started to go up through a lot of the 80s. And yes, we did have a real problem in 1987. There was a stock market crash right at that point. They adjusted interest rates, but then after that, as the stock market or the S&P 500, which is the index, as it started to recover, we started to see them begin to raise interest rates again. So here you have the stock market going up and interest rates going up. That's a little different than what we've been told at times. Things started to go down in the late 80s, early 90s. And so what did the Fed do? They started to lower interest rates. And you can see this red line is going down, going down. This is when Bill Clinton was elected. And a lot of the policies that under President Reagan and Vice President Bush enacted during the 80s, they really started to kick into gear. Now, that's a debatable statement that I just made. A lot of people think Bill Clinton was the answer. Other people think that no, there's a lag time in some of these policies, and it was really during the Reagan and Bush years when things were really set up only to take over into the 90s. But during the 90s, we saw the stock market going up in a pretty healthy way. You had the birth of the internet during that time, and they started to raise interest rates. Then we get into the late 90s up until about 2000, and they didn't really do much with interest rates during that time. But the stock market just kept going up and up and up. That's when you had the whole .com boom and then bust. And then right after that, you had 9/11 happen, which just destroyed the economy for a few years. And so what does the Fed do? They're trying to stimulate the economy. So they start lowering interest rates, and they go down and down and down. And then finally, in about 2002, they leveled off for a while. We still weren't really seeing a really good recovery. And then in about 2003, that's when prices really started to bottom. And we saw the S&P start to go up. Well, as the S&P went up, now you saw interest rates starting to go up as well. And that happened up until about 2007. And that was a good year for the stock market, as I've said in other videos. Well, then we had a major meltdown in 2008 with the whole housing crisis that happened, and stocks just fell off a cliff. They tried to lower interest rates to stimulate the economy, and they eventually got to the point in 2009 where interest rates were at zero. And that's the first time I had ever seen something like that. Now, you would think with interest rates at zero, as the market starts to go back up, why aren't they raising the interest rates to go along with that? That's an interesting point. Why did that happen? Well, there's a number of reasons for that. The biggest one being a thing called quantitative easing, something that the Fed said they would never do. They did it. And they started going in and using money and buying bonds. Well, when you buy bonds, that pushes the prices up, which pushes the interest rates down. They had already gotten to zero. They couldn't really do anything else. And so they had to come up with another trick, and that was quantitative easing. And we went through 1, 2, 3, 4. And you can see a lot of the growth during this time. We did not see a corresponding growth in interest rates until about 2016 into 2015. And in my class, I actually have screenshots of the day that they raised interest rates for the first time. And you would have thought it was Armageddon. Things just went out of control in the markets, even though everybody knew it was coming. It was no surprise, but there were still people that wanted to react to it anyway. And then for the next couple of days after that. But since we were in an overall uptrend at that point, we quickly were able to recover from that. Then you have 2016, and we had the big election that year with Donald Trump being elected president. At that point, he came in and he took a lot of regulations away. He's a businessman. He's not a politician. So he changed a lot of the ways that things are done. And a lot of people loved him for doing that, and a lot of people just despised him for doing that. The media didn't like what he was doing, and it really created some real tension in the U.S. that's still going on to this day. When he came in, we started to see a real improvement in the economy overall. Whether you want to attribute that to him or not, or to companies, or to the aligning of Venus and Mars, whatever, but that's when it happened, was after he took office. And then that's when the Fed started to raise interest rates. And we saw a really good climb in the stock market in 2016, 2017, into 2018, all the way up into 2020. There were bumps along the way, but for the most part, we saw a really solid climb with interest rates climbing at the same time. And the Fed, which is an independent agency of both the president and Congress and the Supreme Court even, they're independent. So they're supposed to be free to make any kind of decisions. Well, this is when Donald Trump would get out, on his Twitter account, and he would start sending out, "What are you guys doing raising interest rates? You should be lowering them. We want to stimulate economy." That's what a businessman would say. They don't really care about inflation. They don't really care about debt. They want to see growth. Okay, they want to see more growth than debt that they have. And so we saw a real expansion of the U.S. economy. The unemployment rate was really low. We saw pretty much anybody that wanted to have a job had a job, and things looked to be going really well until, boom, about March of 2020. That's when the huge pandemic hit, and the U.S. economy was, for all intents and purposes, shut down. And to this, at the time I record this, about halfway through the quarter in 2021, a lot of the U.S. economy is still closed. And we don't know what's going to happen next. But there's a new administration now, and they're really changing things a lot. Whether you think that's a good thing or a bad thing, they're changing things. And I'll be making other videos about modern monetary theory that you can watch, and just the impact of what some of the decisions are going to be. And again, I'm not trying to express any kind of an opinion here. I'm just stating things for what they are. And these things that happen sometimes will have positive effects and some will have negative effects. I don't care personally. I just want to know what's going to happen. It doesn't really matter to me how I feel about it. That's not going to change what actually happens. And that's my approach when I shoot these videos, is just to share what's going on. Whether I agree or disagree is irrelevant. But when we saw the real meltdown in February and March of 2020, well, the Fed immediately started to lower interest rates. And this is where we're at right now, at 0. But we're still seeing some kind of recovery in the economy, and there's a lot of people that are very positive on where we go from here, but there's a lot of people that are very negative, and both sides have their reasons. And I want to show you some other things that you might find helpful. A lot of people that study the market say, if you want to get an idea of what the economy is going to be like in the future, look at copper prices, because when things start to slowly get better, a lot of copper is purchased, and so we see prices going up. Other people say, "Nah, that's outdated. We're in a different age now. We have high tech. We don't have this dependence on copper like we used to have, so that really doesn't tell us." Well, I still watch it anyway, because it can give us at least a point of reference to look at. And you can see over on the right-hand side, for a lot of 2020 and even into 2021, we have been seeing a real rebound in copper. So if you take the old textbook definition of copper, this says that we have brighter days ahead. Now, you can take that for what it's worth, but this is something that I watch every day. Another thing that you can look at is called the CRB index. This is the Commodity Research Bureau Index. This measures things like pork bellies, sugar, orange juice, cocoa, and a lot of the things that people buy, commodities, things that they need to make other products. When I first started in the markets, this was calculated a little bit differently than it is now, but I still watch it, and If we start to see this go up, that might mean there's inflation in the future. We can look over on the right-hand side where through a lot of 2020 and into 2021, the CRB index is really showing some improvement right now. Does that mean there's going to be inflation in the future? Maybe. That's pretty much all we can do right now. There's so many different things going on that we can't make any dogmatic answers with anything. We just have to follow things as they unfold. Now, another thing that I look at too, and I'm still testing this out. A few years ago, I was reading something somewhere, and they said, no. Copper's not what you should look at. You should look at a thing called the Baltic Dry Index. And so I put this up in the charts that I look at every day, but I can't really say that this is giving me much insight. In fact, if you look over on the right-hand side, yeah, it's up a little bit, but it's been bouncing around an awful lot. And this might portend to the economy not being very strong in the future. So I'm still trying to test this out to see if this is a good chart to watch, because what makes up this index are things that are truly more inflationary. And so as those prices go up, we would see this chart go up as well, but we're just not seeing that right now. Is this telling us things are not going to be good in the future? It could be. Or is this chart even relevant and something that we should watch every day? Could be. The jury's still out on this particular chart right now, but I still watch it, and I've been watching it for a few years. Now, another thing that we can look at is gold, because you see all the commercials on TV, buy gold, inflation. All the doom and gloomers are saying dollar's going to go in the toilet. There's not going to be a dollar very soon. Bitcoin is where it's at. And, oh, by the way, call up your gold broker and buy a bunch of gold. Well, that's okay, but when you start to see a lot of advertisements on TV and a lot of people talking about gold, that's usually when you want to do the opposite. If they're saying buy gold, you want to sell it, because the markets have a tendency to act in a contrary manner. This is an ETF of gold. The symbol is GLD. It first came out in 2005, which is kind of interesting, because just about the time this ETF came on the market, this allows you to own gold like a stock. You're not actually owning physical gold, but there is physical gold behind this ETF. So it really strongly correlates with the price of gold. But when this ETF first came out, there was this thing called M3, which is the money supply. And a lot of investors, including myself, really used that heavily. Well, back in 2005 or so, they stopped putting that number out. And then with the gold ETF going public at that time, that's when we really saw gold start to take off, because a lot of people don't know what the real money supply is. There are sites out there that kind of give you what they think it is that I follow. But it's just kind of interesting that those two kind of went or around the same time. Is it a coincidence? Maybe, or maybe not. I've never really found a good answer to that as of yet, because that's a long time ago now, and this ETF has become very popular. But if we were going to see inflation and interest rates go up in the future, don't you think gold would be going up? You can see for the last number of months that gold has really been going down right here. I don't have the usual trend lines on here that I usually draw, like moving averages and things to show you. I just wanted to show a blank chart on this one. But we're not really seeing gold go through the roof, because usually when the dollar goes up, gold goes down. And then when the dollar goes down, gold goes up. Well, they've kind of both been going down. And in one of my other videos, I talk about the dollar, and I have another chart here. I'm going to show you that same chart again. But if we were in a real potential inflationary environment, you'd think we would start to see gold really shoot up. Well, it's not doing that yet. Let's go ahead and look at this chart. And this is the inflation rate. And it goes all the way back to the 1880s. So I hope you can see this okay. This is a different style of chart than what I usually use, but those of you that watch the videos that I do on a daily and weekly basis, you see these charts quite often. But way over on the right-hand side, you can see that inflation is currently at 1.36%. And that's based on the CPI, the Consumer Price Index. And so that's another thing that we watch closely just to get an idea. Is inflation becoming a problem? Are interest rates looking to change in the near future? Then another thing we can look at is the US dollar, where we have seen it go down, and it's gotten all the way down from the 100 level all the way down to about 90. So it's lost 10% just over the last 8 to 10 months or so. And the euro has seen a lot of strength, and I talk about that in another video that I'll put a link to at the end of this video. But we may be at some kind of a base with the dollar index right now, and it may start to go up. The one nice thing I've discovered about currencies, for the most part, they tend to trend really well. Now, it doesn't mean they go straight up or straight down. There are bumps along the way, but currencies have a tendency, once they get going in one direction, they tend to stay in that direction until something significant makes them change direction. You can see back in 2017, we were over 100. It came down, it bounced up a little bit, and then got down to about the 90 to 88 level, formed a base there, and then shot up out of that. That was a significant event, and we got eventually all the way back above 100. Well, now we're going back down to 90 again, and it has yet to be seen whether we're going to form some kind of a base and then bounce back up, or if we're going to keep continuing to drop down to around the 80 level. Now, one other thing that I'd like to show you is a website that you might find useful, and it's called the CME Fed Watch tool. And I'll put the link to this particular website right below this video. I found this a number of years ago, where it's what does the market think is going to happen with interest rates. And what they do is they calculate this every day, and this is freely available. You don't even have to have an account to access this. The CME is the Chicago Mercantile Exchange, and they're a really big player in the markets. Even though most stocks trade in New York, well, you have a lot of the commodities and interest rate instruments like bonds and options that trade in Chicago. And they came out with this tool that I look at. And one thing that's a little bit interesting is at the very top, it gives you the countdown until the next Fed meeting or FOMC meeting. And from the time I record this, it's in 27 days, 10 hours, 42 minutes, 52 seconds. And those have become very important days. The markets will usually be very quiet ahead of them coming out with an announcement. It's usually from about 11 a.m. To 11:15 a.m. Pacific time, which is, what is that, 2 o'clock to 2:15 Eastern time, on the days when they're going to say something or make some kind of an announcement, or if they're going to change interest rates or leave them the same. That's become a really huge event. And what's even more interesting is a few weeks after that, they release the minutes or the notes from the meetings. And that has become a big event too. The markets can then read, what do they talk about in this meeting? Are there things that we need to freak out about? And the market will try to secretly read into whatever it sees in these meeting minutes to try to get some insight, and the market can gyrate all over the place, at least for a short period of time. But what they do is they calculate this every day, and this is based on the next Fed meeting. And I keep saying Fed, it should be FOMC meeting. And they're going to meet on March 17th, 2021. So that's quite a while from now. But what they do is they come up with the probability of what's the Fed going to do. And right now there's 100% probability that the Fed is going to keep the target rate anywhere from 0 to 0.25%, really what they are now. The economy's in a mess, so I don't really see them raising interest rates very soon. But you can watch this, and in my daily and weekly videos, I talk about this, and I bring it up when it needs to be mentioned. But this just can give you some heads up, because really the Fed and the FOMC, they should be following the markets. The market should tell them what to do. It doesn't always work out that way, but that's really how it should be. So If the market is telling them they should raise interest rates, then they're probably going to raise interest rates. And then the inverse of that is also true. So I look at this, and it's been very accurate. And you can go to this website and kind of play around with it. I really just look at where we're at right now. I don't go back and look at things, but in the years that I've been using this, it's never been wrong. They don't always agree. They may say there's a 75% chance that the Fed will keep rates the same and a 25% chance that they're going to raise or lower interest rates. So it doesn't all get buried into the 100% column. But as we get closer and closer, and as all these economic reports come out, that gives the market more insight to think of what's going to happen with interest rates. I hope you found this helpful. Here's some other videos that you can watch. And please let me know if there are any topics that you want to talk about. I have a whole list of different videos that you can watch. But let me know if there's something that I'm not addressing in these videos that you would like to see. Please feel free to subscribe to the YouTube channel and leave me any comments, and both either positive or negative. And I will see you in the next video.